Hi everyone, thanks for joining in. We'll just wait for a couple of more minutes for more participants to join in, and then we'll start. We'll start in about 5 minutes. All right, I think we can start. So today's topic is very simple. Is it the right time to invest in India? Okay, so this is fully going to be India centric. We'll just look at a lot of data. Some of the data you might already know, but purely data oriented information, and then we'll get into how new is able to take advantage of India's situation right now. All right. Okay. So economies across the globe may weaken with growing trends of escalation. So what is happening, right? This is completely on what was happening and what is currently happening right now. Before I start going through with the flow, just give me a thumbs up if everything is okay. The sound, you're able to see the presentation. Uh, if everything is okay or the audio is fine, just give me a thumbs up to say that if everything is okay, and then I'll just keep on going. Okay, fine. All right, thank you. So we went from things getting de-escalated to things getting extremely escalated. We went from free trade to high tariff on trades, and now again the scenario is becoming where there are going to be increase in terms of tariffs. Globally, we are seeing a scenario where there is extremely high inflation. India is not having that high of an inflation, given by what the data has come out. Right, there is some amount of tightening that has happened over the last couple of years. Now we are heading into the place where there is some amount of easing, where the rates are getting cut, and we went from an extremely low volatile scenario to an extremely high. This is what is currently happening right now, the high volatility. You see US operating like a small cap, it's going up 10%, 5%. You're seeing a lot of things happening. So yes, that these are periods of extremely of high volatile periods. Okay, so now where does India come? So India has repeatedly held up as a bright spot in the global economy and is set to become the third largest. So you look at what the projections are, where we were, and where we currently stand, and what the projected rate of return is. So can anybody tell me what is the rate of projected growth for India? You can put your comments in the chat box. Okay, 6 to 6.5%. Okay, maybe 7 to 8%. Okay, 10%. Okay, big number. 6%, 7.32. Okay. So the estimated growth rate for India till 2030 is somewhere projected to be between 6 to 6.5%. That's a very good rate for us to grow at. You're going at 7% or healthy number, because the inflation number also right now is somewhere between, expected rate is somewhere between 4 to 4.4%. Some That's the projected uh, inflation for us in this year. Right. So on all fronts, we are looking very good in terms of an investment avenue, right? And India is not decoupled from global growth cycles, but we have seen that it is quite resilient to global recession. So do you think today we are in a situation for a global recession or a slowdown? What are your views? Do you think that there is a scenario of a slowdown? Okay, there is a war, there are trade wars. Okay, so it does mean that it's going to have some amount of economic impact on global growth. Yeah, what are the views? Yes, slowdown to some extent. Yes, stagnation in the US. All right, many views coming in, all saying that yes, the slowdowns are very well. The possibility of a slowdown is extremely high. Right. So you look at this, since 1980, India has largely avoided full-blown recessions, although it has witnessed slower periods of growth. So is this a scenario where we see a slow growth? Yes, we are seeing some amount of slow growth that is currently happening, but broadly we have been extremely resilient in terms of uh, global growth cycles. If the cycle outside becomes worse, we are not that worse. Right now, over the last couple of years, we have not been that worse. Right? So this does not mean that we have decoupled, but our our effect on, in terms of a slowdown, in terms of all these wars, in terms of high inflation, to us it's very low. So we are well protected from all of these sort of scenarios that can take place in the world. Now let's look at our structural strengths. Right, our structural strength is in remains intact despite whatever hiccups that have come in due to any sort of macro instability outside. Right. So you look at our capex cycle. We look at this capex and consumption cycle because that is very important. Right. Sound balance sheet. Yes. After 2018, with all the recapitalization that has happened, banks have been in a very good shape. Even in spite of COVID hitting us, our banks have been in a very good shape. Right. So that means overall, right, you're with margins also going up with a big amount of period between 21 to 23, where there is a good amount of deleveraging that has taken place in corporate India. You are seeing that we are having a very good balance sheet. Have you seen some amount of policy reforms? Yes, there has been a lot of policy changes, a lot of Make in India policies that have been formed. And does this mean that it is a good thing? Yes, it is a good thing, because all of this is done to improve ease of doing businesses and confidence in India. So more or less, we are seeing that from a policy front, from a macro front, yeah, we are headed towards that. We want to maintain that 6.5%, and then as things start to progress globally, your growth also in India will be structurally higher. Structurally higher. That's what I'm doing. It's not a momentum based game. Structurally very higher. Right. Demand. Now there is a structural rise in terms of discretionary consumption in India. So if you know anybody in India, you would know that their entire expenses as a household have increased from just food and beverages to majorly services right now. So that basket itself has gotten very diversified. Okay, so you're spending on a lot of things in India, and India does have that wallet to now go out and spend, across the world. So you look at this. This is proof, right? So India's corporate debt is now among the lowest at 52% of the GDP compared to other sectors. So there's a healthy, we've had a healthy deleveraging cycle that has taken place for corporates. Our household debt, though high compared to our history, but compared to the world, uh, we have been, we are on the more controlled side. right? And RBI has a lot of timely actions to add to that. Hence, it's a very controlled. Though from our history, it has been on the higher side, but compared to other countries, we are still much better off. Most important thing, you look at this NPA system that's been there. We were at 11.5 gross non-performing asset. Today, we are at a 2.6%. That's how the entire deleveraging cycle has paid out for us. One, deleveraging. Second, very big write-offs that have taken place after the government recapitalizing our banks. Most importantly, debt is completely under control, right? For us, debt as a percentage of our GDP is about 83%. Whereas you look at the larger nations, this is where that uncontrollable inflation starts coming. This is where you see all these wars in terms of tariffs, in terms of currency manipulation start coming in. Where you see here US, Italy, basically Europe, Europe, UK, US, that entire belt in the West has very high debt to GDP ratios. And that is a problem for them. Hence, these levels of slowdown affect these countries much more higher than what it would affect us, right? And going by history and given where we are currently, we are going to be far more resilient than what we were previously as well. Now look at the consumption cycle for us, right? So we were in a period, this is from 2015. So we were in a period where infrastructure had a very low growth and we were majorly consuming. Then after a point, we had periods where your capital formations were going much higher and COVID happened. But the focus was again that we would want to spend more in terms of infrastructure. So now, whenever there is a spend in terms of infrastructure, it usually leads into it fuels that particular part of demand, right? That's where consumption starts going extremely high. Now, consumption is starting to outpace, which means that we have some good way to go where consuming our consumption in India, which is where the growth usually comes in from, that you build capacity and then the demand services that entire part. That's how our nation is built. That is currently happening right now. Right. That's why you see that there's a lot of optimism that is coming in on the India part. So we have done multiple things, right? And some things are still playing out. The story is still playing out, particularly for India. And you will see that going forward in 2030. Right. So one important thing is that the recent change in terms of tax is likely to spare more disposable income, which translates to a boost in terms of consumption for about 30 weeks. So 0.3% of our GDP, right? It's just going to come by virtue of us going and spending that used money. So the tax benefit is very crucial that has come in as a policy, and that is going to push up consumption going forward for the next couple of years, right? Until the next wave of capacity addition starts coming. Likely now that first it would be more consumption oriented, then we will have to account for at that point of time, nothing to predict. But given how things are, the idea is to improve that level of consumption. Now, this is up for grabs because that is India's growth story. Now, where are we in terms of valuation? Is there an actual opportunity that is there on the India side for us to go and invest? Yes, broadly you will see that today we are not trading at a very high premium, but we are one of those nations where it is giving us an opportunity to invest in, because certain sectors within your equity as an asset category is extremely attractive. Certain sectors are definitely not going to be attractive. So net we are in a position where we can go and put a lot of money into India, but we have to be very selective in where we want to put money into India, right? And we've been in this scenarios for a good amount of time. You look at 23, we were very close that the allocation towards equity should be much higher. So you will see, our basket of how we try to invest in terms of asset categories, right? And there you'll see how much as a percentage we're looking to invest into equity and into other asset classes as well, since we follow a multi-asset approach. Right. But given how things are, you can take a small, approach that is going into equity. And that's how we are thinking as fund managers. Now, broadly, this is what I was talking to you about. Is it expensive or not expensive? Slightly on the expensive part, not completely, but given where we are and given what the growth rates are projected to be, we are neutral, right? It's not very expensive at all. So this is a good time for us as a signal that yes, investing in India is good. Investing in equity, we have to be very selective. Now let's get to our think tank, right? What is NEO all about? Knowing well that India is on a very good wicket to in terms of perform. in terms of performance. So the most important thing that you can have is a good strategic allocation mix. This is Ray Dalio. You already know he's a big author as well. So what the investor needs to do is to have a balanced and structured portfolio, a portfolio that does well in different environments. So with this philosophy in mind, we said that we want to create a strategy where we can identify the right asset class and we can invest in them at any point in time, right? Despite where we are in the cycle, we should be able to identify the right asset class to invest in, right? We don't know that we're going to win. We have to have diversified bets. So we see diversification as having multiple asset categories where we're able to maintain, a solid growth rate in terms of stability and in terms of consistency. We should sustain that level of wealth creation. Like that is the objective, right? More 360-degree, identifying the right asset class and investing at any given point in time. That's the whole philosophy. That's that. So we look at strategic allocation, right? What is the best investment option? Is there such a thing as a bad investment? Does performance follow it? We see all these things, right? When we have to reflect, can we predict returns? No, we cannot. So with this in mind, right? What is the best investment? And is there such a thing as bad investment? We look at this entire quilt. I've taken it only up until 23 because 24, 25, once the whole chart comes extremely clear, then you know, but we have a very good knowledge on and we remember history extremely well. Right. So you see this, there's always a new winner and there's always a new loser. Like this is one of our favorite charts. You see from in 2010 and 11, gold was the best. But 13, 14, 15, and 16, gold has not done extremely well. 18, 19, 20, up until 25, right? Including the last 2 years, gold has done phenomenally well. Right. So every time there is a new winner, every time there is a new loser. And it's not necessary that the past winner has to be a winner going forward and the past loser has to be a loser going forward. I'll just pause at this particular chart and why don't you look for it and tell me what has been a past winner that has become a future loser and what was a past loser that has become a future winner. I gave you one example. So why don't you find out what are the other examples across asset categories? Silver, yes, silver does have its own ups and downs, and it has been a good winner over the last 4 years. But there are periods where it does very, very bad. Compared to gold, also, it's much more volatile. Right? What are the other categories that you see? What about small cap? What about real estate? What about debt? Any uh so the question is, can you identify is the I hope the chart is very much visible, right? The question is, can you identify from this chart what has been a past winner that has become a future loser and what has been a future past loser that has become a future winner? So there's a comment that says debt. Yeah, there are periods where debt has done very well. There are periods where it has not done well. Small cap has been a past winner. Yes, there are periods where small cap has done very well, but you look at this 18 and 19. Say somebody started investing, at the peak of 2018 for 2 years, you have not made any money. And then the third year and the fourth year is where you're recouping all the losses that you made. So it's taken you 5 years to make sub single digit CAGR, right? So we here identify this. That's why it's very important for us to identify the right product, the right asset category, right, for us to go and invest in. So we see this chart and then we move on to the next thing. What is our think tank? Like there is no such thing as a good idea or a bad idea in the investment world. It's a good idea at a particular price, right? Right? It's a bad idea at a particular price. So we will only look at the price part. We will only see where the valuations are currently trading and only then take that decision. Right. So our top three lessons. So I'll get to the think tank also. Our top three lessons have been that there are 0 years where everything fails, not a year where everything is negative. Something or the other keeps on performing. Second, 50% of the time in the last 14 years, 50% of the time, which is half the time in 7 years, all assets have delivered a positive return. Second, that's our second lesson. The third lesson, this is what we were talking about. Losers can become winners and winners can become losers, right? So that means that we need to be a lot more versatile and we need to be a lot more adaptive to the changes that are taking place so that we are able to shift and move from one overvalued asset category to an undervalued asset category, right? That's why we have kept Neo, right? Extremely flexible. So there is no cap on a particular asset category. We can go from 0 to 100 in equity. We can go to 0 to 100 in global. We can go to 0 to 100 in domestic equity. We can go 0 to 100 in precious metals, or we can go 0 to 100 even in cash, right? So how do we do well in different environments? This is what I was talking about: domestic equities, foreign equities. So the universe is extremely open for us. We don't have a a certain set of universe. The universe is fully open for us, where we can take advantage of domestic, foreign, short-term debt, long-term debt, precious metals, and commodities. Now, what are investors actually worried about today? I think you guys he clearly pointed out: inflation, war, recession, rising markets, and things being extremely volatile. Surprising, you're not able to, gauge the sentiment. You're not able to gauge the mood outside. These are all things that investors are worried about. What does Neo do? So in the domestic equity part, there we only like to participate in businesses. It's more like a theme, right? It's more like a thematic sort of an investment idea. Say like a India consumption story or like a financial services where you see more and more investors in the basket going across private banks, public banks, financial services, insurance businesses. So we only look at that, right? So where we have a wide market participation, right? These are businesses that are usually large in nature and they can be monopoly oriented businesses as well. Foreign equities, high value opportunities. Basically, this is like your alpha generating sort of position. Buy it only when it's extremely cheap. Right. Short term debt and long term debt. Here we have a scenario where we make high yields plus we get mark to market gains. Right. So today we are in a scenario where your debt in India is extremely attractive. So this category for us then becomes an extremely attractive opportunity for us to invest in. Right. Then there's precious metals. Usually we take this as a hedge against, and that hedge also for us has been on the higher side. So we at a point can go, since it's 0 to 100, we can take high conviction calls even on this, which we have to the tune of 15 to 20%. And then there's commodity oriented businesses when there is a case for reflation. Right. Now, let's look at how we can make asset allocation work there. What do we think, right? We are very, very conscious of the valuation. We are contrarian in nature. The portfolio and the strategy is built with the philosophy that we want to stay away from the crowd, right? And this is a position that this is a portfolio where we build small positions in over an incremental period of time, right? And we understand that going by the top three lessons, a little bit of everything actually goes and works. Now let's look at the think tank. We don't have any asset, we don't have any cap on our category. It is more top down and bottom up. So we will look at how we view top down and how we view bottom up and what are the ideas that we're looking to invest in. It is going to be concentrated across themes. It might not be to a particular name, but the theme will have a very large concentration on, right? Where the intention is to go only towards market leaders, right? So it will majorly be large cap in nature, right? Now, the whole idea of a top down and a bottom up sort of a strategy. So we basket top down as two things. One, do we need an active or a passive strategy? Active means we will go directly and invest in equity. We can go directly buy the paper and we can directly buy the metal ETF. Passive strategy is more global, more sectoral. Say if we want to take a particular basket, so we will only look at it more from a basket oriented thing, right? If the top down idea is that public banks will do well, rather than buying one, we will buy the entire basket because everything is cheap. Right. So this is where a mix of active and passive strategy starts coming. Then we look at it from a bottom-up approach. Now, bottom-up approach, we only look at it from an active strategy basis where there has to be direct equity that goes. We buy a high quality debt paper. This is how we basket a top-down and a bottom-up strategy, right? So for us, let's look at some ideas that we've done. Like I said, public banks, right? It takes us some amount of time that we build our position, then we build our conviction over years. So it took us 1.5 years to completely buy our position into public sector banks as a entire ETF. So top down, yes, a lot of positive signs coming in at the start of our strategy. So we wanted to take a more passive approach rather than an active approach. So we took a sectoral ETF, right? So we are not bound to say we will only do equity stock. No, where there is opportunity within a particular category, we choose the right particular product and only then go and start building our position and our conviction in it. So you see 1.5 years worth of buying, and the exit also is staggered. It has taken us some amount of time to go and exit our entire positions as well. So churn ratios in the strategy is not very, very high. It will be somewhere between 30 to 35%. That's it. So we don't do a lot of churning. We are majorly long. We are long only. We are majorly buy. Right? Only when excessive valuations start coming in is when we start taking out our position in the entire portfolio. Okay. Now, how do you unlock prosperity? Our whole objective is to build versatile portfolios that prosper in all markets. So we understand that in periods where there's high inflation and high interest rate, fixed income does very well. When there's high growth, right, that's coming from companies and there's earnings re-rating, which is the earnings are growing strong, equity tends to outperform. In a scenario where there's no mix and match, right, you need a dynamic strategy. And at that point, a multi-asset strategy, which is very, very flexible, very, very adaptable, can do extremely well. So it's not bound to a particular cap. So usually when you look at multi-asset funds, there's a cap that you have to be net equity this much or particular category, right? Net this much. We don't have that sort of mandate. Ours is 0 to 100, right? This is slightly dated, but when we were looking at it as well, you see how is this strategy done since its inception. It has done very well compared to our benchmark. It has done very well towards your 100% equity products, and it has done very well towards the against the category as well. Right. Plus, when we compare it to a flexi cap sort of a strategy where it's more equity in nature, where they get to go, a mix of large, mid, and small, there also we have been able to outperform, right, in that particular strategy as well. But this strategy has been in the works for the last 3 years, 3.5 years or so. So don't judge us right away, but we are very confident that this strategy can deliver in all markets. Right. So you look at how Neo is able to handle those level of drawdowns. We have not seen this level of drawdown itself come for us since our inception. Right. So whenever we take out the data, it is that Neo has fallen lesser than both the benchmarks that are there. Right. Now, this is where I was talking to you about in terms of the chart. We look at our equity position as a house, right? As a portfolio itself, your equity allocations are somewhere between 75%. But today, when you onboard, this is where the dynamic allocation starts coming in. We are only buying some percentage that's going onto the equity part. Majority is going onto the debt part, and it is in cash. Right. So if you see as a house totally from the portfolio perspective, we are at 75% in terms of equity, 4.5% in debt, which we are only increasing right now in all the portfolios that we are able to build now. So somebody who onboards today will have a much more different portfolio than somebody who onboarded 6 to 7 months back, because the opportunities are different and the pitch to play is completely different. Right. So now we don't have any global. We had global, now there's no global positions at all. Right. Simple. Okay. And if you look at the returns since inception, we have been compounding at a 25% despite having this multi-asset sort of an approach, where our other asset classes have done much more better than our equity positions as well. That's the performance that's how we are able to generate that high level of performance that is coming in, right? Because of the diversified approach, right? So right now the cash levels in the portfolio are about, as a entire portfolio is about 7%, but overall basis we are having somewhere between 70 to 75%. And in terms of our deployment strategy as cash. Now, where do we operate? Now, this is meant for somebody who has a moderate to conservative risk profile, right? Though, so this is not a completely aggressive strategy, but there are parts of the portfolio that we do look to go and play in the front foot. But this is meant for somebody who is whose risk profile is moderate to conservative. right? So it can fit anybody. It is completely tailor-made, right? And the expectation that we have is not our past performance data or what we have been able to deliver, but it is average inflation plus 5 to 7%, nothing more. We don't have extremely high internal benchmarks to sort of meet, but internally all the strategies that we're working with for Neo has been average inflation plus 5 to 7% is the expectation that you should have when you're choosing to invest in Neo. Simple, it's PMS, so 50 lakhs is the minimum. It's a fixed fee, there's no profit sharing. So 1.5% per annum, which is computed on the daily average portfolio value. It is charged to you quarterly, 1.5% plus whatever your GST and brokerage charges are there. That is cut and given and charged quarterly to you. You don't have to pay anything from your pocket, but it is taken completely from the portfolio. Asset allocation is no cap on any particular category that we have already covered. All right. So this has been the team. I don't want to talk too much, but you all know about how we have Varji sir, Rohit, Rajat, and Niranjan sir, who are part of the core team, and then the rest of the team comes. So I think now I'll open the floor for Q&A. Oh, okay, a multi-asset allocation strategy is always better than an all-rounder. Yeah, I think both operate similarly only. So they operate similar. Hey, considering the trend of Q4 results, do you feel markets are run up ahead of fundamental post the ceasefire? See, we do find that there are lesser and lesser ideas on the equity side to actually go and put money. So we're just being cautious. Uh, does it remain completely expensive? No. Yeah, it warrants us to be a little cautious. That's all. Okay, why income or arbitrage funds cannot be considered a shape of SWB? You can see today the spreads for arbitrage are attractive. So a couple of weeks back it was not attractive. Today the spreads are attractive where you can somewhere to 7.25, 7.3% you can make on arbitrage. SWB it's okay. Okay, so there's a question on 50 lakh provided is split and invested at so 50 lakh is one shot, and after that it takes us about somewhere between 6 to 8 months to go ahead and deploy the entire money. So for example, we have seen that somebody who onboarded in January of last year, we were fully deployed and we got multiple opportunities to deploy during the year. And we were fully deployed by the end of August and the end of September. So that is, it took us some time. So it depends on the scenario. So at that point, when the election happened, you were able to capitalize. Okay, so it takes us, yeah, you can take somewhere between 6 to 8 months for us to deploy the entire money. But 50 lakhs you have to give us upfront. That is the norm. Okay, Neo is multi-asset, but how will it concentrate into consumer theme then? Then see, we usually do it with a mix of uh, one direct stocks that are more consumer oriented and ETFs that are again consumer sectoral in nature. So we do a mix of both. Right now, we have been able to completely buy on the direct equity part, right? But in history, since our inception, when we wanted to take a financial services or financialization of India as a category, as a theme, so we were able to capitalize on public bank as ETFs. We were able to buy private banks as direct. So all that has been there. So we are able to capitalize on a particular theme by having the right mix. So it's a basket. So it's a right mix. Sometimes you'll have more direct equity. Sometimes you'll have more equity ETFs. So it depends on the product. But we will look to capture the whole team in that manner. Okay, global ETFs are traded at a premium in certain instances. Do we have allocation currently to them? No. That's one of the reasons of why we had exited completely out. In India, we had exited completely out. One, the momentum came, sentiments were completely for the particular ETF, and plus it was trading at a very high premium. So we did not want to run that risk itself. So we got some good exit out of it, and we did. The strategy is very flexible that way. We capitalized on it. Okay, gold seems to be losing in last week, free falling. Does it mean that global geopolitical risk like tariff, trade wars, or real wars reduced possibility? No, the risks are still very high. Things are extremely volatile. Otherwise, gold would have gone down significantly higher, right? Don't see it from that category as well. See it from yield, see it from currency as well. So when you see all these things, it still shows that there are inherent risks. Okay, let's say 50 lakhs is paid upfront for joining PMS, and then later part of the time the market crashes below its 50 lakh value, should investor top up the fund immediately to match regulatory requirements? See, once you do 50 lakhs, then to match regulatory environment, there's, I mean, regulatory requirement has no rule like that. But when the market falls, definitely you should participate much higher, because then we will be able to buy a lot more ideas and scale up on the existing ideas that we have in the portfolio. Right. So it gives us a lot of ammunition and firepower to go and start acting on our high conviction ideas. So you have to just start off with 50, and the fees also will be on. So if it comes down, then the fees will be charged to you only on that amount. There's no profit sharing. It's on the net asset value. And our team will reach out to you. So whenever there's an opportunity, our team reaches out to you and tells you that, see, there is an opportunity that we would like to scale up in the portfolio. So this is our ask. So will you be able to commit to it? Yes, and we will just go and start up with that. But usually we want to work with participants who are extremely active upfront. Okay, does Neo have other assets like InvITs and REITs? See, we are open to invest in REITs and InvITs. We have that option to go ahead and invest, and we are actively exploring opportunities to invest in, right? Other than gold and silver, yes, of course. What are the commodities? See, usually when we want to look at a commodity, we look at it either from a basket, which an ETF, or majorly from a fund. Usually it is an ETF. So we will look to buy businesses that are more commodity oriented than the actual commodity that's there. The second one is, sorry, what are the commodity spreads in general? See, all PMSs and funds will only invest in uh, liquid parts of the market. If something is not liquid, then they will not go ahead and invest in it. Right. So for us, all this, if so, for example, copper and all these things are not for us as a PMS, it does not work because we need liquidity, right? Tomorrow, when you have a capital ask and a requirement that comes, and if you are not able to sell it, then you are going to be the loser. So we don't want that to happen. So we will only look for liquid opportunities, products that are extremely liquid for us to go out and invest in. Okay. Buy and sell orders. Yeah, it's a completely discretionary oriented PMS. You don't have to do. We will be taking that decision and call for you. You will keep getting monthly reports from our side, and every quarter you keep getting investor letters. Plus, there's a direct channel. You can, if you want to have a one-to-one conversation with the team as well, that we can have. And we have monthly. So we usually have this sort of internal discussions with the whole team as to what has to be conveyed to the investor. So that will happen with you on a monthly basis. And we usually have yearly calls just to give you an update as to what's been happening, and what are we thinking and what you should do for that particular, prepare you for what's coming, and we take it forward from there. Okay. uh, okay, obviously as investors we will try to fund the money during market crash. If the investor is not able to fund it, that's where the doubt is. Got it. Is all right. Done. Thank you. Okay. What about the cap on international stocks now? Does NEO or any other multi-asset hold foreign or US stocks? Uh, See, we have the option to put money outside. There are multi-asset funds also that are putting money in the ETF, that are holding ETFs outside. So option is always there. There's no cap for us right now to go and buy. So on the fund part, there is no, it's all shut. You cannot invest. ETFs are freely trading, right? But when you see it freely trading, you cannot create more units because of our cap. So those units that are actually trading in the market in the supply are at a premium. So we generally avoid. We generally avoid if it's a premium. And if it's not a premium like what it was, we can go ahead and do it. But right now, with all the cap that's there to from the manufacturers, right, it becomes difficult to participate. We're already holding it great, but we already have some good amount of global exposures on the other products. So we are just holding it unless and until it warrants for a deep cut. Okay, what factors should I consider when choosing between small cap and large cap mutual funds? See, a complete evaluation and so when we look at mutual funds to invest in, we only look at it from the category of, okay, is the philosophy of the AMC and the philosophy of the fund manager in line with our philosophy? Right. So we have a current philosophy and what we have as a view. If it's in line with them, clearly it goes there. Whether it is a small cap, whether it's a mid cap or large cap comes later. Then comes on the quality of the portfolio. Has the so when they are conveying and when the conversation is going very well, have they been able to execute on what they have been talking about? Is their philosophy completely seen properly, right? So we look at what they've been doing, how they've been doing things, right? Again, then comes after that saying valuation. Okay, quality of the portfolio is good, fund manager is doing a great job. Okay, quality valuation, if the valuation is not very conducive enough for us as a basket, we will not invest. So this is not a period where we want to invest too much into small and mid cap funds. Opportunity is definitely there. It will keep on getting better. But right now is a period where we would like to go more towards a stable part. So you have to make that difference between valuation to, is it a right time right now? Answer is not too much. Opportunity is definitely there, not too much. Right. So by that logic, then see, when our strategy gives us that flexibility to choose from one overvalued asset class and move from one thing to the other thing, we're able to do it. So these are considers that we, choose, and when we look at it, when we have to look at small, large, mid, you should also be able to do the same thing. In fact, we do have an entire mutual fund division that distribution business that works on this continuously. So, and I'll put out the number also. If you have that requirement that you want to do more on the mutual fund part, let me just put that number out for you. Right. Yeah, this is our official number on the mutual fund part. You can just send us a hi and tell us your requirement. Our team will get in touch with you. Okay. Okay. Uh, what is the difference between sphere and neon? No, it's no difference. See, in terms of strategy is the same. Just that on the neo part, we cannot buy mutual funds. It creates a lot of issues both for you, for the investor, and both for us. So we have decided that okay, for non-resident readers, we'll just keep it operationally separate. Philosophy is the same. Okay, is SWP accepted allowed from the mutual fund similar to MF portfolio fund? Because once accumulation phase is over, it's obviously withdrawal phase once we retire, right? So that's the whole purpose of investing up here. You can SWP out, no problem. What we do is usually we build a lot of wealth on the PMS part, then we make you slowly transit to the MF, where it's easy and tax efficient for you to keep doing HWP. We can do mix of both, no problem. We can have some money that is just growing on the MF part for you, where that is meant first to for the first phase of SWPs that have to go, it will go only from here. Then we feed into it from the PMS part, whatever growth that we're able to make. Simple. Okay. Very much appreciated the whole team of iThought staff. From my heart, you guys are feeding a lot of knowledge and insight to public who are very much interested to learn and participate in both. Thank you so much. Yes, thank you so much for your feedback. But that's not in terms of knowledge. We would like to serve you as well. We would like to make sure that you are on the right path so that your goals are clearly met. Our strategies have been very, very open. We are very transparent in terms of what we want to achieve, what we are trying to do for the investor. But we definitely want to make sure that a lot of people are able to benefit out of the knowledge that we're able to provide. And we want to work with you. So bring in a lot more people, bring in your family members, bring in your friends to this whole operation, because we are very confident that every single person that we want to work with will be able to benefit from all our process that we are setting. Team's pretty young. Okay, is it like graduating from MFM to PMS once we reach particular purpose? Nothing like that. Yeah, nothing like that. We can do the same amount of quality work for you on the MF part. MF is more tax efficient for you than a PMS. That's the biggest difference when it comes to these two, right? Where the tax, it's more tax efficient for you in the MF part. There's no graduation, nothing like that. But when we work, people have that aspiration that they want to, invest in a PMS. So it's aspirational. So why do we need to bring somebody down? The whole idea is to elevate people and improve their life and their standards. So we push them, we help them out in doing that. But the quality of the work in both ways is the same. It's the same research that we've been doing on the PMS business was born out of the MF business. It's not PMS to MF. First, it was MF that we were doing on the advisory business, and then that is what led us into the PMS business. That level of work, that level of mindset. Because now AIF with a ticket size of 1 crore is new normal, so there is no end. Yeah, there will always be complex products that are there, and the market will keep evolving. There's a need. So it feeds into a particular set of the market. It's not that these products are bad, but it feeds into a particular set of market. There's a requirement for a lot of investors outside, and it fits their category. It's tailor-made to them, and we are trying to tailor-make solutions for anybody who's starting off their investing journey, build it up to 50 lakhs for them. Neo is more that okay, 50 is the next. PMS basically is 50 and then the next one. But we also have services, and you're very well aware of it. Milestones 12. So there's a need for everything, and we want to provide solutions for all needs. Okay, I'll keep the floor open for another couple of minutes. Hope I've been able to answer all questions that have come. And if I've not been able to answer something, if there's something that you still want to know, you can reach out to us. There's the number. And I've also put out the number for the MF. If you do not have 50 lakhs and you say that no, I still want to avail services from you, that number is right there on the chat box. Again, I will put it. So you can just send us a hi with your requirement. Okay, can we still remain put in just MF alone? And when we have built a bigger corpus, so is there a funda that we need to upgrade? There's no upgrade here. If I told you it's more tax efficient for you as an investor, if tax is a problem for you, just stick to MF. There's no Spotify sort of thing here. Move from go to ad free all the time. Nothing like that. Depends on your tax. Depends on your status. But it's just more tax efficient. That's strategy. Of course, here on the PMS, it's built for working like Ferrari. But more or less, you'll reach the destination. Similarly, so we will give you the same quality of work. Okay, done. That's my time. Thank you all so much for joining in. Have a great weekend and put out both the numbers. So whatever need you have, please send us a hi, send us your requirement, and we'll do our best to get in touch with you. Thank you so much, guys. Have a great weekend.